The signal that generated that change in silver's verticality was when it broke out versus gold. The spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high that anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, again, waiting on that trigger level, spread silver gold.
The silver pullback has barely affected this bull market. Despite apparent consolidation, momentum has been quietly reestablishing itself. Silver's long-term trajectory remains one of the most explosive in modern financial history, says market technician Michael Oliver. After years of artificial suppression and investor neglect, the metal is reclaiming its value. Price behavior analysis, using spread relationships and momentum structures, shows an untapped market, just starting to extend legs. Oliver's analysis shows a strong silver-gold breakout. He says the relationship is more important than the raw price charts. He recognizes that the silver-gold spread ratio is nearing a multi-year breakout, a signal that has historically preceded sharp vertical silver price movements. A slight increase in that ratio, which is just below 1.3%, can start the acceleration seen in 2010 and 2011, when silver quadrupled in months. Oliver doesn't consider this noise. Silence precedes the surge. Oliver says the silver pullback is market fatigue before a structural pivot, despite many analysts misinterpreting it as the end of a rally. He believes gold is still in the early stages of its macro bull cycle, with a 4-fold increase from its 1999 lows compared to the 8-fold increase at the 2011 peak. The implication is clear. Spreads, the intermarket relationships between precious metals and other asset classes, are the true indicators of capital migration, and both metals have a long way to go. These spreads tell a simple but powerful story. Overvalued equity markets are quietly but decisively losing capital to monetary metals. These spread structures across multiple time frames indicate a new market reality, not the end of a market movement. For silver investors, the bull market's acceleration phase is still ahead. Michael Oliver explains in his interview why he thinks silver's movement will be rapid and transformative. He also explains why he is shifting his focus from silver to miners that will outperform as momentum builds. If you value in-depth data-driven analysis of the precious metals market, please like, subscribe, and share it with other investors who understand that timing is as important as conviction. We appreciate your help and hope you like the film.
It's building a base, which you can't quite see it on the price chart, but on weekly momentum, I could see a clear ceiling that's been built, such that, I'll give you a number, it's tentative right now. You get D silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm going to break out of that base. So all you can do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I got to go to $40 or 41 or whatever, and this is this or that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us, and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous, I'll comment on that in a minute, $50, $50, $50, you know, the surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. The signal that generated that change in silver's verticality was when it broke out versus gold. The spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high. Did anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, again, waiting on that trigger level, spread silver gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, oh, gee, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued and investors just say, phooey with that market. It's a dog. Don't touch it. And when it wakes up so fast they miss it. That's where I think silver is right now. Anyway, so right now, if I were looking at one single chart, I would say, look at the silver gold spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from above 1.2 to 1.32% to be precise, to break out. Momentum of that is already pushing at the breakout levels.
Oliver perceives the silver slide as substantially concluded, regardless of the volatility that has prevailed in recent months. He closely monitors weekly momentum charts, which indicate that the metal is establishing a strong foundation just below critical breakout levels. He contends that silver has been oscillating, quietly absorbing selling pressure while moving sideways. The subsequent phase of acceleration could commence almost immediately after it surpasses the upper boundary at approximately $48. This rare alignment, which historically precedes explosive multi-month rallies, is established by the narrowing silver-gold spread and the momentum structure. This analysis is directly integrated into Oliver's overarching framework, which involves the transition from equities to hard assets. He is of the opinion that the spreads between gold and the S&P 500 are on the brink of a critical breakout point, which would indicate a fundamental reallocation of capital. The same dynamic that characterized the end of the tech bubble and the commodity boom of the early 2000s is re-emerging. However, Oliver contends that the momentum signals are significantly more lucid, and the spread dynamics are significantly more robust this time. According to him, the current situation is not a short-lived rally, but rather the initial phases of a significant asset class transition.
Something's beginning, okay? It's not saying, it's over. It's saying the race just began. And there's another spread that's very, very important. And that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously, during that time, gold was underperforming the U.S. stock market. because it was really going down hard. And therefore, the spread was negative. Gold was underperforming. But since, I actually go back 11 years now, about from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. This is now for the fourth time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5% price of DC gold divided into S&P 500. If you ever close a month at 60%, you blow that entire structure out and gold breaks out to the upside. This is a fresh signal, which when that occurs, it's not old. It's not saying, gee, I'm an old trend. It's saying, I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI, tech related. NASDAQ 100, the same symbols, 4 or 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted. When we divide gold into the Dow Jones 30, or divide gold into the New York Composite Index, indexes people seldom look at anymore, we've already broken out. Whereas you've had that breakout. What it says then is that with the exception of those couple stocks, and by the way, look at those stocks today, they're getting hammered. Palantir, NVIDIA, et cetera, far more than the market. When you lose those leaders and gold breaks out versus the S&P, joining its already existing breakout versus New York Composite and the Dow 30, it's saying there's an asset class shift that just occurred. It's new. It's brand new. And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back into its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an 8-fold bull market to get to those highs. We're only 4-fold right now. So the game is not over. The game is just beginning. Watch the spreads. And on the NASDAQ, that would say, uh-oh, you're probably headed down. Now, not disastrously. We think what's been going on in the U.S. stock market since late last year, in fact, is a topping process. We made our high in January, February for the NASDAQ 100, S&P. We had the headline sell-off, which you don't like. If you're a bear, you don't need a headline. You'll get them later. You know, this bank fails, this company fails. You don't want to hear it at the beginning. So we heard this tariff stuff suddenly became the be-all and end-all of the world. Now it looks like the Supreme Court might sort of push some of that aside, in which case that's not even an issue anymore. Well, let's get it out of the way, because frankly, the reason the stock market would top is not because of some headline, which Trump, of course, tried to solve by saying, oh, I'll give a 90-day delay, and so we had a rally off the April low. But making the new high, for example, in the S&P above the January high, we got another 10% or so above the January high. And now we're slipping off some. We think it's all part of the topping process. The same thing happened in 2000 and in 2007 when the S&P was topping. It made a high, looked negative enough for us to say, get out of this category, dropped, but then came back and made a new high, which was a teaser. Whereas if you succumb to the new high and thought, oh my, the game's on again. No, you were wrong. It was a trap. And in fact, the one in 2007 that made the new high was in October 2007, a few weeks after the Fed, surprise rate cut. So if you bought the Fed rate cut thinking, oh boy, game's on, You bought the top. Okay. Anyway, I think we're in the same situation now. We're getting a laborious top that spans a year or so of up-down action that's confusing, but it's topping according to our momentum work. When that occurs, money will go somewhere else. And the normal two places it's gone in the 2000, 2002, 2007, and 9 bear market and the stock market were T-bonds and gold, especially gold. Well, T-bonds are dogs. They're not behaving well. They get little rallies, little sell-offs, get a little rally today because stock market's weak, but they're stuck in this range for 3 years. They can't get off the mat. Something's wrong there. We all know what it is, okay? So it leaves you, if the stock market starts to break, where's the money going to go? The one place that's smiling, monetary metals. Okay?
Oliver's perspective is unequivocally optimistic, not only regarding the metals themselves, but also regarding the structural transformation they represent in the global financial system. He underscores the fact that investors are still ensnared in a reflexive mindset, presuming that silver will follow if the stock market declines. He cautions that this logic will result in the loss of many. The data contradicts this assertion. There has been a significant increase in the price of gold and silver during recent equity drawdowns. The industrial use of silver, which is frequently criticized as a weakness, is actually becoming one of its greatest strengths due to the increasing demand for solar AI hardware and electronics. This has resulted in an inelastic supply environment that no short-term correction can alter. Oliver highlights the historical absurdity of silver's 50-year trading range. In addition to this, silver has been artificially restrained, despite the fact that base metals such as copper and lead have long since broken free of their 20th century price ceilings to establish new realities at 4 times their prior averages. The outcome is a market that is severely undervalued in comparison to the fundamental conditions of the current monetary landscape and its historical peers. Silver's equivalent price would already surpass $200 per ounce if it were to merely reprice itself in real dollar terms, accounting for inflation and money supply growth. Supply constraints are currently irrefutable. Global silver demand has exceeded mine production for 5 consecutive years, a deficit that is not solely driven by investment demand, but also by essential industrial usage. However, the majority of silver is still produced as a byproduct of base metal mining, which means that the increase in prices has little impact on the production of silver. This results in a feedback loop of scarcity that exacerbates price volatility when investor capital re-enters the market. Oliver believes that when that moment occurs, conventional technical metrics such as RSI or moving averages will be unable to accurately represent the true magnitude of the movement. He reminds us that overbought conditions can endure for months during genuine market revaluations. The broader context is equally compelling. The leadership position of equities, particularly AI-linked tech stocks, is beginning to erode. A quiet breakout is occurring in gold and silver in contrast to the major stock indices. The spread between gold and the Dow has already increased, and the gold toss and P ratio are on the brink of doing the same. These cross-market breakouts have historically been predictive of long-term bull phases for metals and the miners, as they were in the 1970s and early 2000s. Oliver interprets this not as a speculative blip, but as confirmation of a multi-year rotation that is already in progress. The acceleration phase may unfold at a faster pace than anticipated as the walls of the 50-year silver range finally crack. This will not be a gradual ascent. It will be a repricing, a resetting of the market's valuation of real assets in a world awash with depreciating fiat. The signal is evident to investors who are patient. Maintain your stance, maintain your conviction, and monitor the spreads. I appreciate your attention. Please remember to subscribe, like, and share this video if you appreciate precise technical insight and in-depth market intelligence. Stay tuned as we continue to monitor the transition from paper wealth to tangible value. A cycle that, as Michael Oliver points out, is only just commencing.